Good evening and welcome back to Market Master Roland Attenborough. I'm wishing you all a tremendous amount of abundance and love and peace in your life. We all deserve that. So with that, let's get on with the Wall Street. Finished October on a high note as Amazon's blowout rally and big tech's massive AI spending spree reignited growth fever and pushed markets back into bullish territory. The market spent the final days of October finding its footing and ending the month on a steady note, rising modestly as traders rotated back into growth names after tentative open. Conviction built through the afternoon as traders leaned back into the tech leadership. By the close, the S&P rose by 0.25%, driven by the 10% surge in Amazon that carried the entire consumer discretionary sector to the top of the leaderboard. A rising tide lifting everything from retailers to travel stocks. The Nasdaq outperformed as AI optimism returned, while the Dow edged higher on steady late-day buying as yields held about 4.1% or therein. Energy also had a solid session, with Chevron and Exxon both higher after earnings landed well with investors. A flare-up of geopolitical tensions in Venezuela added another tailwind, pushing crude back towards $60 a barrel and reinforcing the sense that stability is driven into sediment. Gold cooled after a record run, and the VIX slipped below 18, signaling calm more than confidence. Beneath the surface, big tech's $380 billion capex wave made clear that the AI boom has entered its heavy industrial phase. More cranes and concrete than code. Across sectors, resilience looked less like optimism and more like endurance. The market wants growth, but it's rewarded by those who can pay for it in cash. What's the investor signal saying? Well, the tape closed with more discipline than excitement, and that's exactly what investors rewarded. After a month of defined by hesitation, the final session showed that the conviction now comes with conditions. The money is flowing proof, not promises. Companies that can fund their own growth and keep margins intact through higher rates are setting the pace, while debt-heavy or story-driven names are fading into the background. As November begins, the market is tracking who can convert resilience into returns. The next leg higher will belong to the balance sheets that can breathe without borrowing. Let's take a look at tech's $380 billion surge. Signals the industrial phase of AI. Wall Street spent the morning celebrating growth. By afternoon, the numbers showed the cost of that belief. Alphabet, Microsoft, Amazon, and Meta now expect to spend over $380 billion this year on data centers, chips, and network infrastructure. That's great for projects like us on the bullseye. Each company raised its capital expenditure forecast, turning the earnings season into an arms race. Amazon set the tone with a $125 billion target and plans to increase it again in 2026. Alphabet followed with a $93 billion driven by cloud and AI expansion. Microsoft pushed guidance higher too, confirming that CAPEX growth will accelerate instead of slow down. Meta narrowed its range, 70 to 72 billion, but investors punished the stock anyway, and its shares fell a whopping 11%, the steepest drop in 3 years, as analysts questioned how its superintelligence program will ever generate cash. The spending wave shows both confidence and constraint. Big tech sees AI as infrastructure, yet the scale of investment now challenges the limits of energy and supply chains and patience. OpenAI's $1 trillion build-out only adds pressure, setting a benchmark few can match. Let's take a deeper read into this. The shift from cloud to concrete. The AI boom has entered its industrial stage. The biggest tech firms now operate like utilities, building the power and hardware that intelligence depends on. Software margins are giving way to physical constraints: land, energy, and materials. AI no longer lives in code. It lives in steel and silicone. Investors are signaling that the capital discipline will define this phase. Amazon and Alphabet look positioned to sustain returns through scale and cloud profitability. Meta and Microsoft facing higher risk as their capex growth outpaces margin expansion. Watch data center construction, grid partnerships, and cooling infrastructure. Those are the levels that now decide competitiveness. The era of limitless AI optimism is over, and the market is pricing who can turn spending into survival. Let's take another deeper read between the market, between nerves and numbers. The data tells one story, the psychology tells another. Every delayed inspection, every rumors of layoffs stretches across timelines and frays confidence. What looks like stable on paper feels fragile in motion. Buyers are negotiating twice. Lenders are checking 3 times. And sellers are discovering that time kills deals faster than price cuts. Housing is no longer about rates alone. It's also about reliability. And companies that simplify escrow, insurance, and inspection timelines are gaining shares as anxiety drives demand for speed and certainty. For investors, the message is clear. This market rewards executive execution, over optimism. And trust has become the most valuable asset class in real estate. 40% crash coming? Well, former Goldman Sachs exec and now CEO of MarketWise, parent company of Stansberry, Chain Inc., and Analytics and Altimetry, just issued what he calls the most urgent warning of his career. He thinks your hard-earned savings can be on the verge of a 40% collapse. He lays out the proof, plus a detailed plan for exactly what to do, and it doesn't require shorting options or perfectly timing the market. Let's go take a look at the energy watch and all this. Oil majors show strength and strain as earnings land. Energy stocks steadied the tape today, with Chevron and ExxonMobil both positioning and posting better than expected results. That underscored how discipline is shaping the next phase of the oil cycle. Chevron's quarter read like a playbook in inefficiency. Output up, cost tighter, cash flow steady despite softer crude prices. Management emphasized holding the line on spending and maintaining flexibility even if oil drifts lower, a stance that resonated with investors looking for reliability over reach. Exxon's update struck a different note. The company boosted its dividend by 4%, signaling confidence. But rising debt and thinning free cash flows hinted at the cost of sustaining that payout. Its growth pushes remaining aggressively with new production and long cycle projects still in focus, but the market questioned whether those gains can hold without stretching the balance sheet. Taken together, the two giants offered a snapshot of the industry, walking a fine line by balancing capital returns with financial endurance as margins tighten and global demand steadies. The backdrop of renewed geopolitical tension in Venezuela added a layer of complexity, briefly lifting crude back towards $60 a barrel and reminding investors that energy stability still has a price. A deeper read on the energy equation? Oil majors are no longer chasing scale for its own sake. The leadership edge now belongs to those who can fund dividends, growth, and transition efforts without leaning too heavily on leverage. Both Chevron and Exxon are testing how far traditional oil strengthens can carry them into the economy increasingly powered by data centers, electricity demand, and carbon scrutiny. while energy's winners will be those that can keep the balance sheet discipline front and center. Chevron's lean model gives it room to maneuver. Exxon's ambitions raised both its ceiling and its risk. For investors, the focus is shifting from who can pump the most to who can finance the future without borrowing against it. Let's take a look at some job stuff. The layoffs headlines have just been clashing with reality. The job market's still holding firm, but the headlines are sounding ominous. Amazon is trimming 14,000 jobs. UPS has announced 48,000 in cuts. Yet behind those announcements, the labor market looks surprisingly steady. State-level jobless claims have shown little change since October, holding nearly 220,000, a level consistent with a soft but stable economy. The data tells a calmer story than the headlines do. Even with a federal data blackout from the government shutdown, state filings reveal no sign of massive layoffs. Claims in California, the largest state labor market, remains close to 40,000, roughly unchanged from a month ago. Economists describe this as a same low fire, low hire dynamic that has defined much of the year. Minimal job losses, but limited new hiring. The calm before the noise. Layoffs at companies like Amazon and UPS sound large, but barely move national totals. Combining those cuts accounts for the less than 1% of all layoffs reported later year. Many affected workers find new jobs quickly, while others exit the workforce voluntarily. The churn is constant, but not catastrophic. Still, the broader tone of the labor market has shifted. Job creation has slowed since spring, and hiring plans are being trimmed across industries. Employers are cautious, but not panicked. The risk is that slower growth and persistent trade functions at a friction of what could be eventually force companies to tighten further. For now, labor remains the economy's shock absorber. The resiliency of jobless claims suggested consumers will keep spending and credit conditions will stay stable. Investors should watch the next month's payroll data for confirmation. If claims stay flat while hiring revives, the soft landing narrative holds. If both weaken, the cracks begin, the surface could finally start to show. NVIDIA's worst nightmare. Instead, this could be overlooked by a $20 company that's already won NASA's trust and is positioned to dominate the potential $2 trillion quantum computing explosion. Well, folks, I hope